All right, let's slow this one down and dig in deeper with standards and exam angles. Which of the following should be considered by a CPA prior to acceptance of an audit engagement of a non-issuer? The quality of the accounting records, the future plans for the company. Choice A says one only. Choice B says two only. Choice C says both one and two. And choice D says neither one nor two. Now, first up, number one, the quality of the accounting records. This is definitely a factor. Why? Because the auditor has to determine whether preconditions for an audit are present. AUC Section 210, which governs terms of engagement, says that before accepting an audit, I must evaluate whether management acknowledges and understands its responsibilities. One of those responsibilities is preparing the financial statements, maintaining adequate records, and providing the auditor with access to all necessary information. If the records are garbage, I may not be able to get sufficient, appropriate audit evidence. And without sufficient evidence, I can't perform the audit in accordance with GAAS. So yes, the quality of the accounting records is a legitimate and required consideration. I don't have to demand perfect records, but I have to ask, are they at least auditable? If not, I might decline the engagement. Now, number two, the future plans for the company. This one's a distractor. My role as an auditor is not to predict whether the company will succeed or fail, or whether their new expansion plan is smart. GAAS doesn't require me to consider future strategies before accepting the audit. Even if the company is planning something risky, I can still audit their present financials. Future viability may come into play later during the audit when I evaluate going concern, AUC Section 570. But at the acceptance stage, it's not relevant. So number two is out. Now, let's tie in a few exam tips.
Well, the key is to always remember the three key pre-acceptance checks: independence, management integrity, and ability to obtain sufficient evidence. If you see anything outside those three buckets, it's probably fluff in the multiple choice options. Business plans, company strategies, or future profitability might matter to investors, but they don't affect whether I, as a CPA, can take the audit. That's the exam trap. They're trying to get you to think like a business consultant instead of an auditor. Watch for questions mixing pre-acceptance versus audit planning. Audit planning includes understanding the entity and its environment, and that might involve knowing their strategies and risks, but that's after acceptance, not before. So when I step back, number one is required, number two is irrelevant. That means the correct answer is choice A, one only. And here's the memory hook. Before I say yes to an audit, I ask, can I audit this with clean evidence? I don't ask, can this business conquer the world? That's for venture capitalists, not auditors. Final answer, A, one only.
All right, let's go step by step on this one. Here's the question. Inquiries of the predecessor auditor prior to acceptance of the engagement should include specific questions regarding disagreements with management as to accounting principles and auditing procedures, the integrity of management. Choice A says one only, choice B says two only, choice C says both one and two, choice D says neither one nor two. Now, let's talk it through. Number one, disagreements with management about accounting principles and auditing procedures. This one is a clear yes. AUC Section 210 tells me that when I'm considering accepting a new audit, I should communicate with the predecessor auditor to understand whether there were any disagreements. Why? Because constant battles over accounting choices or audit methods might be a red flag. If management fought tooth and nail over revenue recognition or audit scope, that tells me life will not be fun if I take the engagement. So yes, this is a proper inquiry. Number two, the integrity of management. This one is also a yes. In fact, this is probably the single most important thing I want to know from the predecessor auditor. If the predecessor says management withheld information, they weren't transparent, or they pressured us to do shady things, then I need to run for the hills. Independence, audit quality, and public trust all hinge on whether management has integrity. If they don't, I can't rely on their representations, and that's a deal breaker. So both 1 and 2 are appropriate and required areas of inquiry. That makes the correct answer choice C, both 1 and 2. Now, here's where I'll expand with standards and exam tips. The AICPA Code of Professional Conduct and AUC Section 210 emphasize that communication with the predecessor auditor, if management gives permission, should cover 3 main areas: information about management integrity, disagreements with management over accounting and auditing, reasons for the auditor change, and understanding of any fraud, non-compliance issues. So think of it as the predecessor auditor knows where the skeletons are buried. I want to ask about arguments, honesty, and why the engagement is changing hands. Exam tip: if you see a choice that asks whether you should ask the predecessor auditor about future profitability or the company's business strategies, that's fluff. The right answers are always about integrity, disagreements, fraud, or reasons for the auditor switch. And here's your memory hook. Imagine you're taking over an apartment lease. Before you sign, you ask the old tenant 2 things. Did you fight with the landlord? That's disagreements with management. And is the landlord shady? That's integrity of management. If the answers are bad, you don't move in. Final answer, C, both 1 and 2. All right, let's read this carefully together. Here's the question. Which of the following procedures would an auditor likely perform in the planning stage of a financial statement audit? Obtaining a signed engagement letter from the client's management, examining documents to detect violations of laws and regulations having a material effect on the financial statements. Choice A says 1 only. Choice B says 2 only. Choice C says both 1 and 2. Choice D says neither 1 nor 2. Now let's analyze it. Number 1, obtaining a signed engagement letter. Yes, absolutely. AUC Section 210 says I need to agree on the terms of the engagement with management, and this is normally done through an engagement letter. That signed letter makes sure everybody is on the same page: what the audit covers, management's responsibilities, my responsibilities, and the limitations of the work. This step always happens before I dive into audit testing. So yes, number 1 is something I do during the planning stage. Number 2, examining documents to detect violations of laws and regulations. Not at the planning stage. That belongs to the fieldwork/testing phase where I gather evidence. Planning is about strategy, understanding the entity, identifying risks, setting materiality, assigning staff, and arranging timing. I'm not yet combing through contracts or board minutes for illegal acts. That comes after planning, once the audit is rolling. So, number 1 fits, number 2 doesn't. That means the correct answer is choice A, 1 only. Now, let me expand with standards and exam tips. In the planning stage, AUC Section 300, Planning and Audit, tells me I should establish the audit strategy and develop an audit plan, understand the client and its environment, assess risks of material misstatement, consider internal controls at a high level, arrange staff and assign specialists, confirm engagement terms with management, which is where the engagement letter comes in. Notice what's not on that list: detailed substantive testing. Examining documents for compliance with laws and regs is actual audit evidence gathering, not planning. Exam tip: when you see planning stage questions, look for words like understanding, assessing, developing strategy, or obtaining the engagement letter. If you see examining, testing, or confirming balances, those belong to fieldwork. That's the trap. And here's your memory hook. Planning is like packing for a road trip. You decide the route, book the hotel, and make sure everyone agrees where you're going. That's the engagement letter. You don't start checking roadside speed limits until you're actually driving. That's fieldwork. Final answer, A, 1 only. All right, let's read this one slowly because it's packed with management duties. Here's the question. Management's responsibilities in the engagement letter include which of the following? Adjusting the financial statements to correct material misstatements, identifying and ensuring that the entity complies with laws and regulations, selecting and applying accounting policies. Choice A says 1 and 2 only. Choice B says 2 and 3 only. Choice C says 1 and 3 only. Choice D says 1, 2, and 3. Now, let's walk through each responsibility. Number 1. Adjusting the financial statements to correct material misstatements. Yes, this is management's job. If I, as auditor, find material misstatements, management has to either fix them or explain why they won't. The engagement letter reminds them of that responsibility. Number 2. Identifying and ensuring that the entity complies with laws and regulations. Yes, this is squarely on management. My role as auditor is limited to considering how non-compliance affects the financial statements, but ensuring compliance, that's management's duty, and it's spelled out in the engagement letter so there's no confusion. Number 3, selecting and applying accounting policies. Again, absolutely management's responsibility. I evaluate whether the policies are appropriate and consistent, but management is the one that chooses and applies them. So when I look at all three, they all belong in the engagement letter under management's responsibilities. That makes the correct answer choice D, 1, 2, and 3. Now, let's expand this with standards. AUC Section 210 requires that the engagement letter states management's key responsibilities. These include preparing the financial statements in accordance with the applicable framework, designing, implementing, and maintaining internal control relevant to financial reporting, providing auditors with access to information and staff, adjusting the financials for material misstatements.
Selecting and applying accounting policies, ensuring compliance with laws and regulations. So every single one listed in the question is straight from those requirements. Exam tip. When you see engagement letter questions, remember the split. Management prepares, auditor opines. If the responsibility sounds like preparing, adjusting, selecting policies, or ensuring compliance, that's management. If it sounds like evaluating, providing reasonable assurance, or giving an opinion, that's auditor. And here's your memory hook. Think of management as the chef. They pick the recipe, accounting policies, make sure the kitchen rules are followed, laws and regulations, and fix the dish if it's too salty, adjust misstatements. I'm just the food critic writing the review. I don't cook the meal. Final answer, D, 1, 2, and 3. Here's the question. Which of the following is correct regarding the auditor's preliminary judgment about materiality? The auditor utilizes the results of the internal control questionnaire. The auditor utilizes annualized interim financial statements. Choice A says 1 only. Choice B says 2 only. Choice C says both 1 and 2. Choice D says neither 1 nor 2. Now, let's unpack it. Number 1, the internal control questionnaire. Here's where the trap phrase comes in. The examiners throw internal control questionnaire into a materiality question because they know you've studied that it's part of planning. And yes, it is part of planning, but it has nothing to do with materiality. According to AUC 320, materiality in planning and performing an audit, materiality is about the size of misstatements that could influence users of the financials. Controls are covered under AUC 315 and 330, risk assessment and audit procedures, not the threshold of materiality. So number 1 is incorrect. Number 2, annualized interim financial statements. This one is correct. At the planning stage, I often don't have final year-end results, so GAS allows me to use the best available information. That means I can take interim financials and annualize them to estimate benchmarks like revenue, assets, or net income. That approach is backed up by AUC 320.A7. Of course, I'll update later if the final numbers are different. So number 2 is correct. So the right answer is choice B, 2 only. Let me add some incidental points from the standards. Revisions. AUC 320.12 says if new info comes up that would have changed my materiality judgment, I revise it, so it's not set in stone. Performance materiality. Defined in AUC 320.09, I set this lower than overall materiality to reduce the chance small errors pile up to something material. Think of it as a safety cushion. Qualitative factors. Even small misstatements can be material: fraud, hiding a loss, or masking a covenant breach. The exam loves to test these.
Controls versus materiality. Always keep them separate. Controls tell me how I test. Materiality tells me what size of error matters. Exam trap warning. This is a mix and match trap. Both answers sound like planning tasks. Only one is actually linked to materiality. The trick is to ask yourself, is this about misstatement size or about audit risk? If it's about risk, it doesn't belong in a materiality question. And here's your memory hook. Setting materiality is like planning your grocery budget. You look at your projected yearly income, annualized financials. You don't decide your grocery budget based on whether your fridge light works, internal controls. Final answer? B, 2 only.